Welcome back to the Wall Street Podcast. Today we're doing a deep dive based on key insights from The Economist. We're looking at their August 30th to September 5th, 2025 issue. We'll be examining some critical shifts, things like U.S. monetary policy, private asset values, how industries are adapting, and even some, well, new investment frontiers, all stuff that's really reshaping the financial landscape for you. So first up, The Economist highlights this escalated challenge to the Federal Reserve by President Trump, including that attempt to remove Governor Lisa Cook back on August 25th. Now, markets seemed relatively calm, but Jackson Hole research, it suggests this kind of politicization. It poses a pretty significant long-term risk, right?
That's right. The immediate market reaction might be muted, but the underlying risk is definitely there.
Yeah.
Jackson Hole research points towards, the potential for higher long-run interest rates if monetary policy starts looking political.
And for an investor trying to navigate this, what's the biggest takeaway? What's the most profound implication here?
Well, it really boils down to an erosion of confidence. If bond investors suspect political influence on the Fed, they'll demand more compensation, especially for holding long-term treasuries. And that effectively means higher long-run interest rates across the economy. It can undermine the Fed's power, even if they try to cut rates, and it just raises borrowing costs for everyone.
Okay, so that's the macro picture. Let's pivot a bit. Let's talk about private markets. The Economist brings up findings from SIPA, that's the Securities Industry and Financial Markets Association. They point out a valuation lag in private investment funds. What's the issue there, and what are they suggesting?
Yeah, SIP has identified this persistent lag. Private fund valuations often don't keep pace with public market shifts in real time. Their proposed solution, it involves using more advanced pricing tech, leveraging real-time transaction data where possible, and developing customized benchmarks. The aim is basically to align those private valuations much closer to true current market value.
To avoid those outdated assessments causing problems.
Exactly. To avoid the performance costs and, potential misallocations of capital that stem from working with stale numbers, it's about bringing more transparency.
That does sound like a step forward for efficiency. But, it's still an opaque market. Are there risks in relying just on this new limitations, maybe?
Oh, absolutely.
Yeah.
Well, the goal is accuracy. You still need really robust auditing. You have to ensure the data inputs, the algorithms, that they're genuinely independent and representative, sourcing truly comprehensive real-time data for illiquid assets. That remains a challenge. So technology helps, but oversight is still critical.
Right. And these pressures, they're not just in private equity. We're seeing big policy shifts forcing change in major industries, too. The Economist talks about the energy sector, cites the halt of Ørsted's huge offshore wind project, $4 billion, right, off Rhode Island.
Yes, citing national security issues back in June. That definitely sent ripples.
And then there's the auto industry, this one big, beautiful bill package.
Indeed. That legislation, largely seen as pushing deregulation, it eliminates the federal EV mandates and subsidies. So what you see is U.S. automakers, Ford, GM, Stellantis, they're shifting emphasis, re-emphasizing petrol vehicles for the domestic market. But importantly, they're still continuing EV development, just maybe more targeted towards global markets now. It shows that strategic agility you need in this kind of environment.
Speaking of adaptation, we're seeing totally new economic segments pop up. The Economist covers the massive shift in college sports, that $2.8 billion NCAA settlement. Universities can now pay athletes directly, up to, $20.5 million a year?
That's the figure. And it's genuinely transformative. College sports, remember, generated double the revenue of the English Premier League last year. This professionalizes it. It creates a whole new economic segment, really. For investors, it means looking at things like athlete talent, team brands, media rights, as tangible assets with clear potential revenue streams. It opens up completely new ways to think about investment in sports.
And kind of extending that idea of new value, prediction markets. The Economist notes their rise, sanctioned now by the CFTC. Platforms like Robinhood, letting people invest in event outcomes. Sports, politics, drawing, $1.4 billion in trades?
Yes. It's blurring the lines, isn't it? Between gambling, maybe, and investing. It definitely brings financial participation to a wider audience. People are allocating capital, assessing risk, but on everyday events, it's a new channel for capital. Definitely carries speculative risk, but it also perhaps demystifies some market concepts for people.
Okay, let's try to crystallize this for listeners. We've covered a lot. First Q&A point. If the Fed's independence really does erode, what are the broader market implications? Sum it up for us.
Okay. In essence, Increased risk everywhere. Bond investors demand higher yields on long treasuries. That means higher borrowing costs for everybody. It weakens the Fed's ability to manage the economy, potentially messes with inflation expectations. It just makes their job much, much harder.
Got it. Second point. For investors looking at sectors like renewables or autos, with policies shifting so much, how should they evaluate companies?
They absolutely most factor in heightened regulatory and policy risk. That means project valuations could be more volatile. So you look for companies showing that strategic agility we talked about, like the Detroit automakers balancing petrol and EVs, or companies with strong government ties, maybe, or diverse global strategies. Flexibility and resilience become key.
Right. And finally, these newer things, pro-college sports, prediction markets, how do they change how the average person engages with finance? What's maybe the most surprising part?
Well, they definitely bring financial concepts closer to home for a lot more people. It blends entertainment with investment-like activity. They make market dynamics feel more relatable, maybe. But they also introduce new kinds of speculation into daily life. The surprising thing, perhaps how quickly Main Street seems to be adopting what were once fairly sophisticated financial tools just for these non-traditional assets.
And ultimately, this whole shifting landscape, it does directly affect your daily finances, no question. Could be higher mortgage rates from Fed uncertainty, could be the price or type of car available. And now, these new ways to invest or maybe speculate through sports or event markets, it's changing consumer behavior, changing financial literacy for all of us in real time.
Absolutely. It's worth considering how these new forms of capital, new kinds of risk, are being defined now, not just on Wall Street, but filtering down to Main Street, and thinking about how that really shapes the financial landscape of tomorrow.